All right. Today is Monday, December 5th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight, and here it is, round number 2. I've been working since 5 o'clock in the morning, and I'm still going. A lot of energy going on here. Meanwhile, you can barely keep your eyes open, right? You work for 3 hours, and you're already bitching and moaning. You're tired. You gotta get a foot rub, you gotta talk to your counselor. Get it together already. He or she who hustles end up in Brussels. The rest, you stay home because you're too lazy. What's in Brussels, Maverick? I don't know. I just thought it rhymes pretty good. We got viewers from Brussels. Let us know in the comments so they know I'm not lying. But anyways, if you're saying what's round number 2, what are you talking about? We just got a video out, charts to watch, updates, a lot of these recessionary themes we talked about. You might want to check it out. But if you already did that and you're watching this right now, welcome to the show and let's start already. And here it is, in focus tonight. Get out. This is at least according to your boy from Morgan Stanley, Mike Wilson, who said that we're going to see a Santa rally, counter-trend rally all the way to the end of the year. Now he says, no, we're done here. It's over. I've seen enough. Down we go. We'll talk about that in a minute, but folks, I've been consistent in this channel in saying the inevitable destination is a recession. It's just how we're going to get there. Is it going to be because the Fed is going to stay the course and tighten aggressively, which will lead us into a recession? But the beauty of that is we're going to skip the stagflation part. Or is the Fed gonna wimp out and cater to the crowd who are bitching and moaning right now and complaining the Fed is overdoing it, they're gonna crash the economy? And if they do that, inflation is gonna pop higher again, then they're gonna have to raise interest rates higher once again, but at that time the economy is gonna be a lot weaker, and interest rate hikes then will damage the economy a lot more than they're doing right now. So every time we get a piece of data, macro data that supports that the economy is heading into a recession, that is the consensus, at least in this channel. Nothing new here. But when we get a good, quote-unquote, piece of data, be it the jobs number, be it whatever, we don't jerk off right away like the bulls and say, oh, this is it. This is the soft landing right here. We actually say, maybe the Fed is not doing enough. If they pivot prematurely, what's going to happen is inflation is going to pop higher again. This is how we view the data. And now even the bulls are starting to capitulate. You might have heard Paul Kruger. That guy is capitulating right now. Even Jason Furman. He now says maybe the Fed is going to go higher. So even these propagandist economists on behalf of the regime, they're now saying the same thing. Whoops, maybe the Fed has to go higher. In other words, the recession is now in the bag, baby. And guess what? Last week, we got the employment report, and it doesn't matter what number they give us, what number they cook for us. It doesn't matter. 263,000 jobs, 138,000 jobs, doesn't matter. They're going to revise the number down, up, doesn't matter. And folks, of course, the bulls at least say, oh, this is an indicator that a soft landing is going to happen. The Fed is tightening. The jobs market is still okay. But then again, the devil is always in the details, because the household survey actually shows that the economy lost jobs. But the take from the employment report was wages shot up significantly higher, which is yet another indicator that inflation is not dead, it has not peaked, and if the Fed pauses or pivots prematurely, inflation has all the tailwinds intact to pop higher again. And therefore, you got Larry Summers, who came out and said the Fed will need to raise interest rates even more than the market anticipates, and perhaps even more than the Fed anticipates. Because today we got yet more macro data, both inflationary. We got the services PMI. That gained steamed higher, indicating that inflation will indeed pop higher if the Fed pivots prematurely. Along with factory orders, they're accelerating higher again. So yet we have more and more data supporting the inflationary theme and more data supporting the inevitable destination of a recession. Yet we don't have a lot of data supporting the expansionary theme, which is the soft landing theme that the bulls are betting all in on. And you might say, hey Maverick, what do you got against wages shooting up higher? Isn't this what we should be hoping for? Workers been lagging the rate of inflation, and finally wages are picking up higher. If wages are picking up higher, inflation is going to pick up higher again, and this gap between wages and inflation will widen even more. So net, you might be celebrating the pay raise or the new salary that you got, but you're celebrating prematurely because inflation is going to come back and bite you right in the ass. And net, you're going to lose to inflation again, even with a bigger margin. And folks, this is not sustainable. The Fed must end this insanity, even if the cost is the recession. We have inflation surging higher, and folks are now taking more debt, swiping those credit cards up and down, up and down, up and down. And what's going to happen by the end of this? With rates going higher and higher and higher, and the inevitable destination is a recession. Folks are going to default on their debt, or we're going to see this recession that was supposed to be a recession morphing into a depression. So the Fed must end this insanity now. For you to say that, oh, maybe the Fed should just ease up, why would they destroy the economy? Well, the economy is going to get destroyed either way, Fed or no Fed, and this environment right now that we're seeing, this inflation, is not sustainable. And the damage is going to accumulate. It's going to be permanent if it's not tackled right now. I mean, are you happy with this economy when only the 1% are splurging and having a good time, to the degree where sales of Lambos are shooting up higher, to the point where the company now unable to produce and meet the demand because there's so much demand. The rich are splurging. This is an economy that works for the rich. But what about the millennials? Any millennial couples right now looking for a home? Well, good luck. And you got all of these real estate moguls crying on TV. Oh, the Fed is doing too much. We're seeing the collapse of the real estate market. What are you talking about? Home prices are down, what, 3%? 5%? 10%? Wake me up when they go down 50, 60, 70%, because that's what should happen for affordability to even be remotely attainable. And they say, why are millennials cheering for the crash? They're cheering for a crash because the American dream for them got reduced to owning a used van. Nobody can afford a home anymore. The Fed should continue in the path until real estate values are crushed by 50% or more. That's what we want to see. And sure, we're going to have a lot of victims, a lot of damage in the economy, but I did not design this Ponzi scheme. I'm just playing by the rules. It's a Hunger Games kind of economy, and that's that. But the Fed crashing the economy into a recession right now is a lot better than letting inflation go and then come back later and crash the economy into a depression. Keep that in mind. Now, let's talk about the equities market and what's going on here, because we have the best fourth quarter rally since 1999. I wonder what happened back then. I wonder what happened after that. Anyways, the rally is supposed to be sustainable. It's supposed to go all the way to the end of the year, even beyond. A lot of folks are saying that this is the bottom. The bear market is over. Forget about the recession. We have a soft landing coming. Santa is coming to town. Here's the problem. The recession force is also coming to town. And the evidence for that is not just the recessionary theme that we've been seeing in the market for at least a few weeks right now, but it's also from this. Everybody been talking about, hey, if China reopens, we're going to see revival and reacceleration of the economy again. And higher we go. Now, China did not reopen, did not reverse the thing restrictions, the draconian restrictions, but they succumbed to the pressure by the public, and we're seeing some easing. And initially, you combine that with the oil price cap and OPEC Plus holding ground. In the morning, we've seen oil prices shooting up higher, and even equities, at least initially on Friday and all the way to the futures, were destined to go higher. But all of that faded away. Equities went down big. Oil reversed the gains, went down big. The Chinese names also reversed the majority of the gains and closed at the lows of the day. As if the market is saying, no thanks, there's something bigger here. And that something is the recession force. China reopening means more tailwind for inflation to move higher, which means the Fed is way behind the curve, remains way behind the curve, and they need to come out even more aggressive and crush the economy into a recession. And the market slowly but surely is succumbing to that reality. And that leads us to the call for Mike Wilson. Mike Wilson now says, forget about the bear market rally that I said is going to be all the way to the end of the year, the Santa Claus rally. It stops now. I've seen enough. With the yield curve inversion to this degree, something big is going on here. A big recession is about to happen. That marks the end of the bear market rally. And a reminder, this is what Mike Wilson said initially. Take a look.
Now, Mike, I'm going to read you a quote, and it reads as follows. Previous lows in equity markets are likely to be retested as there may be a significant decline in corporate earnings. We're inclined to think that this market decline could happen between now and the end of the first quarter of 2023. Now, if someone gave me that quote, Mike, I'd think it was you. Except it wasn't. It was JP Morgan's Marko Kolanovic yesterday. Now, Mike, you like to be contrarian. You have been through much of this year. I have to say that view now of early 23 earnings risk is almost consensus, Mike. How are you thinking about it as we go into a new year?
Yeah, I mean, look, you can say it for other people too. We all try to, stand out with something that's, insightful or different. And you're right. I mean, our call this year now has become pretty much consensus. But that's why we flipped in October, quite frankly, is we felt like that call, the fire and ice call, right, Fed tightening into a slowdown, became consensus. Now we see kind of this idea that we're going to make a lower low in the first quarter. I don't think that's quite consensus yet. But I tell you what's not consensus is this tactical rally. Okay, that we watched our competitors. We talked to a lot of clients to try and get a sense for where that sentiment is.
Right.
And I would say this is one of the most hated bear market rallies that I can recall, even more so than this summer. So I think the right setup now is this rally will go further and it will probably drag people back into thinking that the bear market is over. And then that will be part of the signal for us to kind of press on the other side again.
So just to recap, what Mike said is just before October, because we had a really bad September, a lot of folks, it became consensus that down we go. We're going to break the June bottom, and we're going to see an epic crash all the way to the end of the year. Everybody became bearish. So Mike decided to go contrarian here and said, you know what? We might see a tactical rally, a bear market rally all the way till the year end. And this rally will extend all the way till the end of December. And then we go down in 2023. Now Mike is flipping right away and saying, watch out, the bear market rally stops right now and down we go from here, right now. Forget about 2023. We go down from here, right now. And now that Mike said that, what's going to happen is the market is going to blast higher in the next few days. And then they bring Mike on TV, on CNBC, and he does the retractment of the retractment and says, well, maybe the initial call has some legs to go. And then what do you know? That day, exactly, the market goes down again, and Mike embarrasses himself. So, Mike, if you're listening, maybe you shouldn't do that, or maybe you should. On behalf of Bears, take a shot for the team so the prophecy can come through. But anyways, Mike aside, we're looking for signs to the end of this bear market rally. And these signs, at least in my book, number one, SPX rejection and reversal from the trend, which by now we all aware of. And the question is, we got the rejection. Did we get the reversal or not? Stay tuned for the charts analysis. We're also looking for a VIX reversal. We hit 20, even below 20, and now the VIX popped higher. But is it a reversal yet? Number three, we're looking for a bounce in the 10-year yield. Today we got a bounce, but we're waiting for a confirmation. And I'm using my wording here carefully. I'm not saying a reversal in the 10-year. I'm saying a bounce. Because in the case of the VIX, a reversal means we make higher highs. In the 10-year, I'm not sure if we're going to make higher highs. I'm just looking for a rally from this point on. And the reason is, if the market is anticipating a recession, the 10-year will have a hard time making new highs. Just saying. And the same goes with the Dixie. We're looking for a bounce, a rally right now, an oversold rally. That will mark the end and the reversal of the bear market rally. I'm also looking for a rejection for Apple and a reversal from 150. We might have gotten the rejection today, but did we get the reversal? Again, for that, stay tuned for the charts analysis. But I'd like to share the comment by the viewer. He says, Mav, I'm a member and I saw your video last night on not seeing any indicators to short the market right now. I know it hasn't been a full day yet, but what is your input now? It appears that the SPY is bouncing right off the trend line, that is the resistance trend line. I personally opened short positions on Friday. Now, this is what we call brass balls. The guy doesn't need a confirmation. He's seen enough. It's a risky strategy, but it paid dividend today, and it could pay dividend in the days to come, even the weeks to come. What he's talking about is, look at the SPX, the SPY, whatever you want to look at, it doesn't matter, the S&P 500. We have a trend line, a downward sloping trend line of resistance. We keep hitting that over and over and over again. That marks the end of each bear market rally. And down we go. So the trader is saying, I've seen enough. I don't need to see a confirmation and all of these signs. I'm confident enough that down we go from here. And I say that I'm sharing this view with him, but I'm a little bit more cautious here. I share the view of Katie Stockton, who is an unbelievable chartist, and she has been right since the beginning of the year. Now listen to what she says. She's a little more cautious. Take a look.
Well, I'm not entirely convinced that this is the start of the reversal down, but it certainly doesn't help the indicators. We have short-term momentum falling off a bit in here. It's starting to impact our short-term gauges to some degree, but not on a widespread basis yet. So we want to give it a couple of days and reevaluate. There are signs of upside exhaustion, very similar to what we saw in mid-August. So your comparison, Mike, to the recent summertime relief rally is very fair. The indicators are set up similarly. The declines, on the back of that, of course, were very severe. So we're sort of mentally preparing for something like that. I do have a sense that perhaps the positive seasonal influences into year end might prevent that until January, but even still, the upside appears to be limited here.
So again, good signs for the bears, but we need to see a little more because we're going to see oversold rallies. We're going to see the bulls, the money managers who've been pumping this rally higher, not capitulating right away. We need to see a little more. But again, the brass balls tactic could pay dividend. If it happens to be that this is indeed the end of the bear market rally, and all what we need to see is the fact that the chart of the S&P 500 got rejected where it should be rejected, and that's that. Now, in the talk of the end of the bear market rally, because we have a lot of delusion saying, oh, we've already seen the end of the bear market, it's over. Katie Stockton says, not so fast. You might see that happening if the VIX shoots up higher to 50 and above. Take a look.
You mentioned, as we've been talking about the similarities to what we saw in the summer, what are the differences aside from just the seasonals? Is anything about the nature of the rally, the internal behavior, the leadership, or anything distinguishing it from what we did see in August with that peak?
Not to any great degree in my work, except for the fact that it's just a more mature bear market cycle at this stage, and we like to see it mature just in terms of the time frame, which we're considering to be year to date. But the market internal measures have not gotten to that place where they're really extreme yet. I think we are going to need to see some kind of VIX reading that's up in maybe the 50 area before we see this bear market cycle culminate. And market breadth looks very similar as well. We saw great breadth expansion for a few weeks, and we have that now here as well, and yet it still is at a lower high versus previous highs. So the breadth measures are still in these downtrending situations that suggests that we'll see more participation on the next down leg.
Now, we have more bearish calls than this. I personally think that the VIX will shoot up higher, way above 50. We covered the call of some trader who bet that the VIX will pop all the way to 150. I doubt that 150 is going to happen, but we could go to the 70s, even 80s, before we see the bottom in this bear market. Most importantly, if we have a recession theme invading the stock market right now, and the economy is heading into a recession, usually energy stocks don't do pretty good if the economy is heading into a recession. The crash is actually led by energy stocks. So what is Katie Stockton says about all of that? Take a look.
And is the pullback that we're seeing in energy, of course, by far the leadership sector of the year, it's continuing today. It's still very modest in the grand scheme of things, but is that something that you think you should be concerned about, or is it an opportunity?
Well, if you think about the energy complex, it really hadn't rallied that or downtrended just like crude oil prices had or like natural gas prices had. So it's somewhat remarkable how well the energy stocks have held up in light of those declines in the commodities. Now that we're seeing natural gas today down something close to 10.5%, again, I find it somewhat remarkable that the reaction just isn't that terrible. And yet natural gas is looking overdone to me on the downside based on the DeMarc indicators, and WTI crude oil has good support in the $70 to $75 per barrel range. So I do think that there's a floor to this weakness in the commodities, and also that the energy stocks will be able to resume their longer-term uptrend and also longer-term trend of outperformance. We have in the energy sector something close to a 60% gain year to date, and I think we can trust that next year won't be quite as impressive in terms of relative performance.
Now, I remain an oil bull, but I'm less optimistic than Katie. I think that if 85 in Brent is taken out for good, for sure, meaning we have a confirmation that it's done, I don't know. What I know is I'm going to get out of oil entirely. I'm going to take my profits and say goodbye. Am I going to short energy? That's a different question. I need to see a little more than 85 being broken before I say, okay, it's time to short energy. I will talk more about the energy market in the commodities coverage and again the charts analysis. So stay tuned. But with that out of the way, let's move on to the stock market coverage, and we begin with the closing of the indices today. And here we go. The Dow Industrial Average down by 482.78 points, or a decline of 1.40%. The Nasdaq leading the pack to the downside, down by 221.56 points, or a decline of 1.93%. The S&P in the red, down 72.86, or a decline of 1.79%. When it comes to the sector's performances across the board, they're down. Shame in all of them. All of them are in the red, but the laggards led by energy, cyclicals, financials, this is a risk-off kind of day. It's a recession kind of day because what are the outperformers today? Yes, they're all in the red, but look at utilities, healthcare, defensives. Those are the recession type of sectors. And yes, they're down, but they're outperforming. What about the advance to decline ratios? NYSE 10% advancing versus 89% declining. Pathetic. The Nasdaq 21% advancing versus 77% declining. On to commodities, and the talk of the town today is oil, energy, what's going on with OPEC Plus, and then how the Russians are going to retaliate. And initially, both the WTI, Brent, were shooting up significantly higher. Natural gas, it's a different story. It was down on Friday and it was down again Sunday night. So we knew ahead of time that natural gas is weak. And the reason here is the weather, of course. The weather is warmer than expectations, but the winter season is still young. Number two, the talk about a peace deal between Russia and the United States, a settlement in Ukraine. What you're seeing in the news right now is, or doesn't reflect the reality, which has been a lot of talk behind the scenes between the US and Russia about a settlement in Ukraine. If that happens, natural gas will go down further. But for now, we're not calling the end of natural gas, and the reason is we know the Freeport facility will be operational at some point. We know the Europeans are going to run out of natural gas in 2023. And this is why I'm hesitant to short energy, because the tailwinds remain really, really strong. And an example of that, when we talk about the tailwinds versus the headwinds for crude oil, for example, the tailwinds, at least today, the Russian price cap, which is comical, by the way, $60. That's the cap, which is right now above what the Russians are selling their oil for. So how is that sticking it to Putin going on? And of course, the problem here is that the Russians don't want to be told what to do. They don't want a price cap. And the question becomes, how are they going to retaliate? If they choose to do so by cutting output, that will push oil prices higher again. So therefore, I continue to say, the energy market right now is at a critical level. We know the recession theme is creeping in. That is negative for energy. We know the technicals are bad for energy right now, but we still have strong tailwinds, folks, and that could play out. Now, let's talk about the headwinds for oil, because the headwinds won at the end of the day. Headwind number one, in anticipation of the price cap, the Russians flooded the market with these tankers that popped out of nowhere, and now they're parking in Istanbul in Turkey. So we have an oversupply for now, at least for now. Number two, there's a lot of talk and optimism about the reopening in China and how that will be a revival for the economy and corporate America and yada, yada, yada. But the Saudis are not seeing what's going on in China as positive. They either see the lockdowns continuing, or despite the lockdowns, the Chinese economy is so weak right now and damaged that even if the lockdowns lifted, the demand for oil is going to go down. And therefore, the Saudis are cutting prices for Asian consumers. We're talking about China, Korea, Japan, but mainly China. And this is a headwind, pushing prices down. So at the end of the day, the headwinds won. And for the tailwinds to make a comeback and win, we need to see massive retaliation by the Russians. We'll see if that's going to happen or not. But for now, what about metals? Down across the board, the dollar was up. So we see gold down, silver down, copper down, platinum, palladium, all down. When it comes to softs and grains, any notable movers here? Mainly to the downside, we have notable losses for grains, led by oats. Oats are down over 6% today. And then we have declines for corn, wheat, rice. So again, while the stock market initially, at least looking at the reaction of Chinese stocks, Apple, were saying that the reopening in China is happening, it's in the bag, we should bet on it, the commodities market is saying, meh, we don't see it. We don't see China reopening. Or even with the reopening, the Chinese economy is so damaged, it doesn't matter. It's heading into a recession either way. When it comes to meats, we don't have notable movers today, so that's that. Moving on to the options market, the big casino, the volume was down big, and that took out the support for the market. Therefore, we saw the selling force taking over all the way till the end of the day. This is the opposite picture of what we saw back on Friday. On Friday, the selling force disappeared all of a sudden, and the buyers took over. Today, we saw the opposite, and the reason is no volume in the options market. Nobody buying calls here in a significant way. Regardless, at number one, the hottest table by far is Tesla, with about 1 million contracts traded today. About 51% of those were calls. And at number two, Apple, with around 975,000 contracts traded today. About 57% of those were calls. And therefore, we saw Apple initially popping higher. Everything was down in the morning, but Apple was higher. And I took the opportunity to short Apple, and it paid dividend by the end of the day. We'll talk more in the charts analysis, but at number three, Amazon, with around 750,000 contracts traded today, about 63% of those were calls. On to the unusual activities that took place in the options market today, and notice the theme here, folks. This is really important. When folks are buying put options on real estate, what are they really betting on? They're betting on yields to pop higher again. We're talking about the 10 here. This is not good for the equities market. When they're betting against Chinese names, what are they betting on? They're betting on the dollar rebounding higher. This is not a good outcome for the equities market, so pay attention now. And the first trade is for the ticker ARI. This is for the Apollo Commercial REITs ETF, and this is a bet against this ETF. They're buying puts, in other words, they're betting that the 10-year is going to pop higher again, and they bought the $10 puts for the expiration date February 17th, with expectations that ARY will go down and lose more than 13% of its value by then. They paid around 55 cents apiece to enter this trade, all in all spending around $1.4 million. And here it is, the FXI, the Chinese ETF. Somebody's fading the rip here, and they bought the 25 puts for the expiration date February 17th, with expectations that the name could go down and lose more than 12% of its value by then. They paid around 75 cents apiece to enter this trade, all in all spending around $1.5 million. And by the way, I did follow this trade exactly. And then we have the SPY, the S&P 500. Again, somebody's bidding for more declines to come, and they bought the 365 puts for the expiration date January 13th, with expectations that the SPY could go down and lose more than 9% of its value by then. They paid around $2 apiece to enter this trade, all in all spending around $1.5 million. And then what about the trade for the ticker DHIDR Horton? A home builder. Somebody's buying puts in a home builder, fading the rip. In other words, bidding for the 10-year to pop higher again. And they bought the 75 puts for the expiration date February 17th, with expectations that DHI could go down and lose more than 11.5% of its value by then. They paid around $2.30 apiece to enter this trade, all in all spending around $1.6 million. And then what about the trade for the ticker C for Citibank? Somebody's bidding against the name here, buying the 42.5 puts for the expiration date February 17th, with expectations that Citi could lose more than 7% of its value by then. They paid around $1.50 apiece to enter this trade, all in all spending around $1 million. And then what about the ticker BX, Blackstone, a name that I'm shorting, and I continue to short? Somebody sees more declines to come here. Something is brewing in Blackstone. I don't know what it is, but I know it's bad. And somebody agrees with me, and they bought the $70 puts for the expiration date February 17th, with expectations that Blackstone could lose more than 14.5% of its value by then. They paid around $3 apiece to enter this trade, all in all spending around $1.6 million. And lastly, at the bottom of the table, what about the ticker DIA? This is the ETF for the Dow Jones. The Dow Jones has been the outperformer, beating the SPY, beating the Qs, beating the Russell, but somebody bet that this outperformer is about to go down, and they bought the 320 puts for the expiration date February 17th, with expectations that the Dow Jones could lose more than 6% of its value by then. They paid around $5 apiece to enter this trade, all in all spending around $2 million. On to the heat map. What's going on here? A bloodbath across the board, with the exception of the Chinese names. They pretty much closed flattish, and flattish is good in this kind of day. And by Chinese names, we're talking about Alibaba, Pinduoduo, JD, TSM, Taiwan Semi, Apple, Boeing. All of these Chinese companies outperformed the stock market today. But in reality, forget about the Chinese theme. Which sector remains the outperformer day in and day out, regardless of the theme? The answer is, how about Big Pharma? Flattish? But flattish was good in this kind of day. Now, Eli Lilly, that thing went ahead of itself a little bit, so it's going to pull down. And when it pulls down, it's going to take the XLV down with it. But this could be a good pullback, not in Eli Lilly, but in the rest of them, maybe the ETF XLV, for at least some dip buying if you're betting that the recession theme is here and it's about to be the predominant theme. Here's some corporate news for you. You see Tesla down big, over 6% for the day, and the reason is we got some bad news from Shanghai that Tesla's cutting the output for the Model Y by 20%. And of course, Tesla executives and Tesla, the company, came out and said, these are all fake news, nothing is happening here, nothing to see, everything is fine. The market said, I don't believe you. I believe there's a problem in China. And the same goes for Apple. We got bad news that Foxconn is reporting sales for November were down by over 11%. Now, Foxconn produces phones for a lot of companies, but still, this is a bad leading indicator for Apple. But we know that the media is going to protect Apple all the way till the end, because they know if Apple goes down, it's game over. And immediately the media comes out and says that the iPhone factory will restart production by early January. According to some anonymous source, some sources familiar with the matter. Okay, my only source familiar with the matter is Xi Jinping, and he says no deal. And here's the heat map for the ETFs, a bloodbath across the board. It's hitting value, hitting growth, but what are the outperformers? The XLU, XLV, again, the recession theme is outperforming here. Not a good look for the stock market right now because it throws cold water on all of these calls that, hey, maybe the soft landing is going to happen. Look at this is a good piece of macroeconomic data. but the market is viewing this as, oh, inflation is popping higher, the Fed will have to be more aggressive than they even think, and this will lead us to the inevitable destination of a recession. On to charts, and we begin with the SPY, the S&P 500 30 minutes chart. What do we see here? On Friday, we got a gap down, but the dip buyers showed up. That could be because of options expiration, but they did not close the chart above the gap, which kept the question that this could go down again. And indeed, we got a gap down in the morning today, and the chart lost 405 as support big time, and it went all the way almost to the next support at 398 and then bounced higher by the end of the day. Now look at the RSI, it is oversold, so it wouldn't be out of the ordinary to see a bounce, an oversold bounce. And if we do, we have some resistance here. One would be the top of a breakdown candle in the 30 minutes chart. The other would be where the candle, as you can see, bounced from that level. It doesn't matter which level it is, but it is a zone. We could see an oversold pop, at least in the morning. And what I'll be watching for is, are they going to fade the rip again? If they do, and we see a loss of 398, now we're getting closer and closer to the confirmation that the bear market rally is kaput, over and done with. And here's the daily chart for the continuous contract, the futures of the S&P 500. And as you can see, the support remains intact. If the chart loses 3,960, then we're talking. This is a reversal. And we can confirm that if we look at the RSI, it is in a slight negative divergence. But most importantly, the MACD is showing red impressions in the histogram. Now, the week is still young, but if we continue to see these red impressions in the histogram and the chart loses 3,960, now we got a confirmation of a reversal. And if you're looking for the confirmation in the SPX, which most traders are doing so, here's the weekly chart for the SPX. And as you can see, we got a rejection from the same trend line of resistance that's been going on since the bear market started earlier this year. But do we have a confirmation? The answer is not yet. The confirmation happens if the chart goes down and closes the week below the low of the last candle, which happens to be 3,937.69. Then we got a confirmation, and down we go. The Q's 30 minutes chart. Again, when we talk about the SPY closing the gap but not closing above the gap on Friday, the Q's didn't even close the gap. So that left the door open despite the dip buying since the gap down that we could flush down on Monday. And indeed we did. And the Qs lost 280 as support. Now it's getting a little oversold. So can we see an oversold bounce at least in the morning? The answer is yes. And it could take us all the way to the top of the breakdown candle. That would be good resistance. And if the chart pulls down right away, say in a gap and crap in the morning, and the chart loses 284.26 as support, now we're talking about the reversal becoming stronger and stronger and stronger. And perhaps the end of the bear market rally is here. Here's the daily chart of the Q's continuous contract. Notice that the support remains intact, 11,689. Yes, we have a slight divergence on the RSI, but we have no confirmation in the MACD yet. I'll be waiting for 11,689 to be lost as support and for a confirmation to happen by the end of the week on the MACD before I say, okay, now we have a reversal in hand. And here's the IWM 30 minutes chart for the Russell 2000. Yesterday, we talked about, yes, the Russell outperformed both the SPY, the Dow Jones, the Qs on Friday, but it also formed a double top. The double top played out today, and the Russell lost 188 as support, and it even lost 183 as support. Bad look for the Russell. The good news is it is oversold a little bit, so we could see a bounce. The question becomes, is it going to be a gap and crap? And if it is, down we go all the way to 174.22. But this is the most important chart, the dollar, the Dixie, daily chart. My number was 103, where the dollar might find a, I wouldn't say a bottom, but a rebound base. But the rebound could happen before that. There are no rules in the book that says, hey, the Dixie has to wait till 103. All along, at least starting last week, we've been looking for a rebound in the dollar. We were looking for the double bottom to hold. That did not hold, but the RSI, the MACD were telling us all along that the dollar is looking for a rebound coming. Is this it? The answer is we have the rebound, but do we have the confirmation? Not looking at this chart, not yet. And we need to see a confirmation before we say, okay, the bear market rally is reversing. But do we have a confirmation in gold? Let's take a look at gold, and whoops! Look at that flush down in gold. And if gold loses 1,763 as support, and we see a crossing in the MACD indicator, that's it for gold. The ABC pattern is over. That means here comes the rebound rally in the dollar, and that means here comes the reversal in the equities market. How about Brent oil, a weekly chart? It makes me really, really nervous. It could go either way. This is going to be a decisive week for oil, and again, by the end of the week, this chart could look drastically different, and I'll tell you why. If it becomes clear that the recessionary force is taking over and 85 has lost its support, we will see capitulation by oil bulls, including me, which will produce a big flush down candle. On the other hand, if oil holds and we see the commodity moving higher again, we could see capitulation by oil bears who've been bidding big time against oil. They will be forced to short cover. We will see a big green candle by the end of the week and the week to come. And therefore, I say this week is really critical for oil. It could go either way. And here's the daily chart for the 10-year yield. Again, it is bouncing from 3.5. Is it going to hold at 3.5? It has a long way to go to prove the 3.5 is going to hold. The reason is, look at the RSI, remains really weak. The MACD remains really weak. It remains in negative bearish momentum. We need to see crossings in the MACD. We need to see the RSI firming up before we say, okay, 3.5 is going to hold for now for at least a rebound rally in the 10-year yield, which is not going to be good for what? It's not going to be good for the XHB home builders. It's not going to be good for real estate, and it's not going to be good for tech. And here's the TLT, a daily chart. It is blasting higher, but it reached overbought conditions and it is pulling back. And therefore I say, I'm not really sure about a reversal in the 10-year. I'm just going to call it a bounce because 3.5 could hold. And we see a rebound and then down it goes again. We're talking about the 10-year because the recession force is here. We see the TLT rallying even higher. So keep that in mind. How about the VIX? 4 hours chart. We have a bounce off 20. It's going according to plan. It's a good opportunity to buy puts at a cheaper price, but I'm not going to feel out of the woods here until I see the VIX above 24.29. And for new viewers, yes, I am bearish. And I've been waiting to bet against the market. But I've been fooled before, seeing the VIX bouncing from 20 and then it goes down again. I need to see the VIX capturing another support line. That would be 24.29. And then you look back at our conditions for a market reversal. If the VIX is above 24.29, then we have a confirmation that the VIX has reversed. And it's about to make higher highs. It might go all the way to 33 and beyond. Here's Apple, 30 minutes chart. Big move higher in the morning initially because iPhone production is going to be resumed in January. Blah, blah, blah. I took this as an opportunity to buy some puts, and I did because look at the RSI, got way overbought. And why would Apple rally when we have a recession theme storming through the market? That is stupidity. And of course, the puts, at least for now, paid dividend. Now here's what's going to happen. We could see a reattempt at recapturing 150 because Apple bulls and the pumpers are not going to give up easily. They've been smacked in the face repeatedly. Every time they get their heads above 150, aka the no entry zone, whack them all. They get hit right away. But when are they going to capitulate and say, okay, enough is enough. This is not going to go above 150 again? At least not right now. Maybe when they lose 145 for support, but I would be conservative and go when they lose 140 as support. Then we know it's bye-bye, it's over, and I will double down on the puts. Tesla, 30 minutes chart, it looked good. It looked as bull flag consolidation, but then we got the bad news in the morning, and immediately we got a gap down in Tesla. Now it's getting a little oversold, so we could see a retracement, a bounce higher all the way to 183.80, but then if it reverses and makes lower lows again, that is a shorting signal. To where? To closing the gap below. You see that saucer bottoming? That gap will be closed. And then what about Bitcoin? Tulips, daily chart. We're still looking at a bull flag. We'll see if it's going to play out or not. Waiting and waiting and waiting. And lastly, I want to talk about VLO Valero. This is a weekly chart. Unfortunately, I made a video last week talking about the shortage in diesel. And I said that I've been playing this by buying Valero. And the name went up big. So far, so good. But since then, the name went down because we have the recession force showing up. Even with the drop that we got in the last 2 weeks, my position is still up because we got in early. But the problem is some viewers, at least new viewers, when I said that I'm playing this, the shortage in diesel by Valero, by being long Valero, they bought the name right away and unfortunately they got hit hard and the position is now down big. Now remember, before that video, I made another video and I said warning to oil investors. I said that I remain bullish, but I'm hedging like you know what. And the reason is I'm seeing the recession force creeping in. I'm seeing the headwinds amplifying. So I remain long, but I'm hedging. And folks, I really hate, and it keeps me up at night when I say something and then folks listen to me and lose money because of me. That is the one thing that I hate the most. So here's what I'm going to say. Here's a weekly chart for VLO. You got the Fibonacci retracement levels right in front of you. If you bought the position recently, then you got 119.5. If that's broken, cut your losses, get out. But if you've been long, like me, for a while now, and you listen to my advice, and you have hedges, you have puts, insurance against your position, this is what we should be looking at. We have seen before a cup and handle formation of VLO, and that produced massive gains. What we could be seeing right now is another massive cup and handle formation in the making. And if that is the case, then this is a massive buying opportunity. But we don't know that yet. Keyword yet. If it appears that the cup and handle formation is not going to happen, and you'll know that if the chart goes below 119.5 and it starts to trade at 110, you know that the cup and handle is not going to happen. And that is the point where we're going to reassess. We're going to look at the futures for the commodity, of course, and we're going to reassess the tailwinds versus the headwinds for the energy market all in all. And if it appears that the tailwinds are losing and the headwinds are taking over in a big way, then it will be the time to get out and perhaps short energy. We're not there yet. Keyword yet. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? Not much. We have the trade deficit, and that's it. With that, folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Take care.
You know what it takes to sell real estate? It takes brass balls to sell real estate. Go and do likewise, gents. The money's out there. You pick it up, it's yours. You don't, I got no sympathy for you.